Welcome to this explainer. Whether you're gearing up for your ACCA financial management exam or you just really want to understand those massive, invisible gears that are constantly turning the global economy, well, you are in exactly the right place. We're going to completely unpack the macroeconomic forces and financial mechanisms that absolutely shape our modern business reality. Think of this as your personal expert tutor session, where we'll be taking some highly complex topics and breaking them down into clear, actionable insights. So here is our roadmap for today. We'll start with macroeconomic targets explained, then move on to fiscal versus monetary policy, check out the modern business environment, dive into capital and money markets, and finally, look at the fintech revolution. Now, we all kind of like to think that business leaders, executives, and entrepreneurs are in total control of their company's destiny, right? But did you know that an overnight interest rate decision by a central bank literally half a world away can completely wipe out a company's entire profit margin for the year? It's wild. This explainer is going to show you how massive external forces are truly steering the vehicle. Because your daily business decisions, they absolutely do not happen in a vacuum. They happen within this highly complex, deeply interconnected financial environment that's dictated by state policies and global markets. All right, let's jump right into Section 1, Macroeconomic Targets Explained, or as I like to think of them, the ultimate destinations of the economy. So governments have these four main macroeconomic policy targets, and managing them is basically a totally precarious, high-wired juggling act. First, they desperately want economic growth to boost national wealth. Second, they want low inflation just so prices don't spiral completely out of control. Third, they aim for full employment so people actually have income. And fourth, they strive for a balance of payments equilibrium, which just means the country isn't bleeding cash through unsustainable trade deficits. But here's the kicker, and it's absolutely crucial. Fixing one target almost always derails another. Seriously. Like, say you successfully push for full employment. Great, right? Well, now citizens have more disposable income. That causes a massive surge in demand, which pushes prices up, and boom, you just triggered the very inflation you were trying to avoid. Or if you stimulate massive economic growth, consumers feel wealthier, they start buying way more imported goods, and that instantly damages your balance of payments equilibrium. It's just a constant high-stakes tug of war. Moving right along to Section 2, fiscal versus monetary policy. Think of these as the steering wheel and the pedals of the economy. To manage that crazy economic tug of war we just talked about, policymakers basically have two primary levers, and it is absolutely vital to know who is pulling which one. First up is fiscal policy. This one is controlled directly by the government itself. It's all about how the state collects revenue, through taxation, and where it decides to inject that money via public spending. Then we have monetary policy. Now, this lever is typically pulled by an independent central bank. Monetary policy is the management of interest rates and the actual physical supply of money flowing through the economy. So, to keep it simple, the government handles the taxing and the spending, while the central bank handles the flow and the actual cost of the money itself. Okay, so why does this all matter to you? Well, because these abstract national policies will hit your bottom line with incredible force. Think about a corporate expansion for a second. Let's say you've planned to build this huge new warehouse, but suddenly the central bank decides inflation is running too hot, so they tighten the money supply and hike up interest rates. That's monetary policy in action right there. Practically overnight, your cost of capital skyrockets. That bank loan you desperately needed, it's now twice as expensive, and suddenly building that new warehouse isn't even profitable anymore. Or think about fiscal policy. If the government drastically increases corporate tax rates to go fund some new infrastructure project, your net cash flows shrink instantly. These policies literally dictate your day-to-day cost of doing business. Let's move into Section 3, the modern business environment. Time to look at the roadblocks and the rules. As a financial manager, your decisions are constantly surrounded by these really strict state guardrails. First off, competition policy restricts monopolies and price fixing to keep the playing field fair. You can't just go and buy out every single competitor without serious regulatory approval. Second, government financial assistance. This actually offers some vital opportunities. A smart financial manager is always actively seeking out targeted state grants and subsidies to help fund a local expansion or some new research. Third, we have green and sustainability policies, and these are huge today. Things like carbon taxes and emissions compliance will directly impact your investment appraisals. Honestly, a cheap piece of machinery might end up costing you millions in environmental fines later on. And finally, corporate governance regulation. This exists mainly to solve what we call the agency problem. See, managers might occasionally be tempted to act in their own self-interest, giving themselves massive bonuses, rather than acting in the best interest of the shareholders. Strict corporate governance mandates the exact executive oversight and ethical reporting needed to stop that dead in its tracks. Which brings us to Section 4, Capital and Money Markets, the engine and the fuel of the business world. Before we dive into the specific markets themselves, we really must master the role of financial intermediaries. We're talking about your commercial banks, pension funds, insurance companies. They are the ultimate matchmakers. And they don't just passively match people up. They perform two incredibly essential, highly technical functions. The first is risk transformation. Look, as an individual saver, lending your entire life savings to a single risky startup is absolutely terrifying. But a bank pulls money from thousands of savers, spreading and absorbing that default risk so the individual simply doesn't have to. The second function is maturity transformation. Savers generally want to deposit their money short-term, right? They want access to it tomorrow if they need it. But businesses, they need 20-year loans to go build factories. Intermediaries bridge that massive gap, magically transforming short-term deposits into long-term funding. Now, the big distinction to make here between the two major types of markets is all about the timeline. First, we have capital markets. This is the realm of long-term funding. When you're looking to issue equity shares or corporate bonds to fund some major 5-year expansion project, you go straight to the capital markets. Then you have money markets. This is entirely for short-term liquidity, usually for periods of up to a year. You are definitely not building a factory in the money markets. Instead, you're issuing commercial paper or maybe taking out short-term bank loans, just to make sure you can cover next week's payroll or quickly finance a sudden inventory purchase. Drilling down a bit further into those short-term money markets, financial managers utilize some highly specific instruments just to keep the lights on. Interest-bearing instruments are pretty straightforward. It's like a short-term deposit that simply pays you a set percentage of return. But discount instruments? Those are a bit more fascinating. You don't get paid regular interest at all. Instead, you might buy, say, a government treasury bill for $95. When it matures in a few months, the government pays you its full face value of $100. That $5 difference, that's your return. And finally, we have derivative instruments. Their value is, well, derived from an underlying asset, and wise financial managers use them primarily as a safety net, really just to hedge against sudden, dangerous swings in currency exchange rates or interest rates. And finally, Section 5, the Fintech revolution. These are the game-changing upgrades happening right now. It is genuinely breathtaking how fast this financial environment is evolving. Decades ago, we completely relied on traditional banking, physical branches and the notoriously slow manual matchmaking of those financial intermediaries. Then the 2000s rolled in and brought digital platforms and electronic trading. But today, modern fintech is completely rewriting the core architecture of financial markets. We are seeing peer-to-peer or P2P lending platforms that allow businesses to secure funding by just bypassing traditional banking intermediaries entirely. No bank needed. We're also seeing blockchain technology being utilized to make international trade finance settlements nearly instantaneous rather than taking weeks to finally clear. Access to capital is just becoming incredibly fast, highly automated, and wildly decentralized. So as a financial manager, your ultimate goal is always to maximize shareholder wealth. But as we've seen throughout this whole explainer, you are never, ever doing that in a vacuum. You're constantly navigating clashing macroeconomic targets, dodging the roadblocks of sudden monetary policy shifts, adhering to strict corporate governance, and racing alongside decentralized tech. The rules are quite literally shifting beneath our feet every single day. Understanding this environment isn't just some academic exercise for an exam. It is the absolute baseline for survival. So as traditional intermediaries get bypassed and markets start moving at the speed of light, here's the ultimate question. Is your business actually ready to adapt to the new financial environment?